Buckle up because today we're hitting the fast lane of financial news, and it's all about U.S. inflation, interest rates, and what this all means for the markets. You've likely heard the term inflation buzzing around more than a bee in a botanical garden. In simple terms, it's the rise in the cost of goods and services over time. In April, U.S. consumer price inflation dropped to a two-year low of 4.9%, prompting a sigh of relief from the markets, which took it as a sign that the Federal Reserve's attempts to curb inflation are finally bearing fruit. It's like when you've been at the gym for months, and finally, those abs are starting to show. But it's not all sunshine and rainbows. The core CPI, that's Consumer Price Index minus the ever-fluctuating food and energy prices, rose by 5.5% in April. It's still above the Fed's 2% target, much like an overcooked turkey at Thanksgiving, too hot and a bit uncomfortable. Now the Fed has been like a determined gardener, trying to prune back this rampant inflation. The tool they've used? Hiking interest rates, the cost at which banks can borrow money. Their latest meeting ended with a 25 basis point increase, pushing the target Fed funds rate to between 5% and 5.25%. Think of it as turning up the thermostat in your house. It makes borrowing a bit less comfortable, cooling down economic activity. However, the market is like that skeptical friend who doesn't quite buy your story. It's predicting interest rate cuts by the end of the year. It's like saying, sure, the party's going well now, but we bet the music stops by midnight. Michael Yoshikami, the founder and CEO of Destination Wealth Management, chimed in on the situation. He suggests that a slower U.S. economy or even a shallow recession might help to avoid a steep market downturn in the second half of 2023. It's like putting your car in a lower gear before a steep downhill, giving us better control over the situation. Yoshikami also warned about the risk of companies guiding the market more conservatively on forward earnings. The concern here is that higher borrowing costs could squeeze margins, like a boa constrictor tightening its grip. He advised investors to be skeptical of valuations, particularly in tech and artificial intelligence sectors. Think of it as avoiding those shiny apples that look great but might not taste as good as they look. Finally, it's important to note that just because the market is predicting rate cuts doesn't mean they'll come. It's like expecting a surprise party just because your friends are acting suspicious. According to Yoshikami, policymakers may try to subtly steer market expectations rather than taking definitive action in the near term. In conclusion, all eyes are on the Federal Reserve as we navigate the roller coaster ride of inflation, interest rates, and their impact on the markets. As for investors, it's essential to stay informed, be skeptical, and make sure you're not buying a shiny apple that's rotten at the core. Stay tuned for more updates and insights, because in this financial world, you have to keep your eyes on the road.